Most people think a massive stock market crash means every single company is losing money. What if I told you that today, more stocks actually gained ground than fell inside the S&P 500? It sounds completely impossible when you look at the sea of red on your portfolio tracking apps. But a tiny group of hyper-expensive tech giants completely overpowered the rest of the market. This was not a slow bleed across the economy. It was a targeted, aggressive tech execution that triggered a multi-billion-dollar global domino effect. If you know exactly where that money went next, you can instantly spot the massive trap most retail investors are walking into right now. To understand why the Nasdaq plummeted over 2% today, we have to look closely at the chip makers. The companies building the physical hardware for the artificial intelligence boom have been setting records all year. But today, the ultimate industry darlings completely collapsed. Micron technology plunged over 13% in a single afternoon. Nvidia shed over 4%, dragging its total market valuation back below the $5 trillion mark. The real shockwave started overnight in South Korea, where the Kospi index crashed 10% and triggered automatic trading halts. This happened because massive chip suppliers like Samsung and SK Hynix lost 12% of their value in hours. Rumors hit the wires that production for advanced AI memory chips might actually be slowed down. Investors suddenly panicked that the endless demand for AI infrastructure might finally be hitting a hard wall. What most people do not know is that this exact panic created a massive paradox in the consumer market. While tech stocks were getting absolutely crushed, a few specific household names did something completely unexpected. Amazon actually ticked up and gained ground during the worst of the morning sell-off. Microsoft also managed to stay resilient and book green days despite the heavy market pressure. This proves that big institutions are not completely abandoning the market. They are simply moving their money out of high-risk semiconductor bets and into massive, cash-flowing software ecosystems. They want concrete proof of earnings rather than just promises of future AI revolutions. The market is forcing a heavy valuation correction on companies that ran up too far, too fast. Before you skip to the end to buy the biggest losers, you need to look at what the bond market is signaling about the rest of this week. The immediate path for the next 3 days is going to be driven by extreme volatility. We have a massive catalyst dropping tomorrow when Micron releases its official quarterly earnings report. That single event will dictate whether tech rebounds instantly or slides another 3% before Friday. Wall Street expects the market to chop sideways with sharp, unpredictable swings until those numbers are fully digested. If you enjoy deep financial insights like this, hit that subscribe button right now so you never miss our daily market breakdowns. The big players are also hedging their bets because the probability of an upcoming interest rate hike shot up to 85% today. That is causing traders to de-risk their portfolios before the weekend arrives. Because of this sharp dip, 3 specific stocks have entered a prime buying zone for patient investors. First is Nvidia, which is now sitting at a noticeable discount from its recent high. Its core business still fundamentally controls the entire AI computing landscape. Second is Amazon, which proved today that its massive e-commerce and cloud business can act as a safe haven during a tech storm. Third is Alphabet, which dropped 5% earlier this week and is looking highly attractive at these adjusted price levels. These are blue-chip giants with massive balance sheets that can easily withstand a temporary market correction. The surprising part comes next when we look at how fast these exact dips usually get bought up by algorithmic funds. History shows that these sudden sector rotations usually exhaust themselves within 4 to 5 trading sessions. Once the weaker hands are shaken out, the big institutions tend to flood back into the exact same quality names. Keep a close eye on the market tomorrow morning to see if the tech giants can officially stabilize.